I can see people are coming in. And we'll give them a few minutes to log in. It's middle of the day, so I'm sure people are coming from other meetings, other locations. Now COVID's done, so there's a lot of driving. So we'll give them a few minutes to join in. I think this is also a very timely webinar to talk about interest rates and the economy and the outlook around that, because Bank of Canada just came out with their thinking. And I'm very, very curious and eager to hear your thoughts on that piece as well, Nigel. Maybe we'll give people 1 or 2 more minutes, and then we can talk about it. Like, I can't wait to hear what your thinking on this one is. Although I feel like most people knew where it was trending, and yet you would hope that it would do better than that kind of thing. So it's tricky.
Yeah, it's a complicated topic, but thanks for having me on the webinar. And when we're ready to go, happy to jump right in and share my thoughts on developments this week.
Yeah. Any major data that we are expecting in the month of April that could have impact on people's decisions and thinking, Nigel?
Well, we do have CPI data for Canada for the month of March that will be released next week. That, of course, will have implications on the outlook for the Bank of Canada's interest rate policy. So we're going to be keeping a close eye on that. But the developments this week are very important, and I think we frame how every data point is going to be viewed going forward.
Cool. Well, we are 2 or 3, so I will kick it off. Thank you, everybody, for joining. And I know more people will keep trickling in as we go. Very excited for everybody to join us today for the webinar, and very, very interested in just hearing Nigel's perspective. Nigel today has joined us. He's an investment analyst with Veritas Investment Research. He's an award-winning analyst, like not once, not twice. He keeps winning new awards and is definitely respected a lot and valued for his expertise in the industry. He's won the Starmine top analyst for banks, top 2 for earnings estimate accuracy, top 6 for stop picking. And of course, year after year, he's proved that his research and his analyses is the top of class in the industry. Prior to this, he has also worked at Say Street as an associate in alternatives investment solution. And so for all things banking, equity markets, and even alternatives and real estate, I and most of the industry looks to Nigel as the expert. He, of course, has a Bachelor of Science degree from University of Toronto, was graduated top of class, and he's a CFA charter holder. So thank you for joining us today, Nigel. It's a pleasure to have you on the webinar.
No, thank you. Thanks for having me on. Glad to join and share my thoughts on the market and the outlook from here.
Absolutely. And as some of you know, and maybe the others have not met me before, I'm Khushbu Jha. I'm the founder and CEO of Buy Properly. We are a platform for investing in alternative assets, largely real estate, but just last week, we launched our second category, which is private credit. And so we have private credit deals live. And of course, we've always had real estate, and you will see more alternative deals coming in. We've also won a lot of awards like the UBS Top 10 Global FinTechs, CIX Top 20 Innovative Companies in Canada, Top 100 FinTech Companies, Top 100 Marketplaces. And so I think through our awards, what we've done is being able to build awareness of the fact that we as a company are very, very committed to increasing access to investment opportunities for younger folks. The industry seems to somehow not yet come to terms with how the younger folks invest, which is more online, smoother, lower fees, easier, convenient. sort of an Amazon-like experience and a Netflix-like customization in simple terms. And so with that, I would like to kick off the webinar. But before I get into questions, so we are all on the same page, I do want to start the webinar by just reading out what the Bank of Canada governor just came out with. He's saying, I realize that what most Canadians want to know is when will we lower our policy interest rate? What do we need to see to be convinced and it's time to cut? And he responds saying, the short answer is we are starting to see what we need to see, but we need to see it for longer to be confident that progress towards price stability will be sustained. So Nigel, let me kick off with the Bank of Canada governor's statement and turn it over to you on what do you think of the Bank of Canada's stance, and how do you think that impacts the outlook?
Sure. I think before we get into specifically the Bank of Canada, we can provide some background context about how to think about potential scenarios. And in my view, there are 4 scenarios that could play out. The first is a no landing scenario where we have strong economic growth, low unemployment, and inflation also moving lower. This is, for the most part, what I think the market was expecting heading into this week. Another scenario is a soft landing scenario where economic growth is weaker, but there's no recession, and inflation also continues to move lower. A third potential scenario is a hard or harder landing, where we do have a moderate or severe recession, unemployment moves up, and inflation also comes down. And the last scenario is probably the worst potential scenario, which is a stagflation scenario where we have a recession coupled with inflation remaining high or continuing to increase. So with that as some background, we can now discuss the policy rates both by the Bank of Canada and by the Federal Reserve. And we have to talk about the Federal Reserve, which is the US central bank, because it does impact the interest rate environment here in Canada. So the US released CPI data on Wednesday, yesterday, and that came in higher than expected. The issue with that is when you have hotter inflation in the US, coupled with strong economic growth, it decreases the likelihood of rate cuts by the US central bank, the Federal Reserve, and may even increase the chance of a rate hike. And the reason I say that is when you look at the month-over-month increase in what's referred to as core CPI, which strips out volatile items like food and energy, the 3-month annualized rate for core CPI in the US was around 4.5% as of March. Now, 4.5% is a very elevated level of inflation. And when you look at monetary policy in a restrictive period, central banks tend to raise the monetary policy rate to about 150 basis points above the rate of inflation. So if inflation, core inflation in the US remains at around 4.5% based on recent trends, the Federal Reserve is likely or more likely to raise its policy rate to 6%. Now, the issue here is that we have divergence between rate expectations for Canada and for the Federal Reserve. So based on the CPI data that came out yesterday and the Bank of Canada's monetary policy announcement, the market has pushed out rate cut expectations. So for the Federal Reserve, the market now expects the first rate cut to occur in September, maybe even in December. And that's revised from an expectation that rates would be cut in June. And there's only 2 rate cuts at most, or less than 2 rate cuts priced in for 2024 now by the market for the Federal Reserve. In contrast, the BOC is expected to cut rates in July, which is just pushing it back 1 month from June. And the market expects 2.5 rate cuts by the Bank of Canada. So there's a clear divergence in the expectation for interest rates for both the Bank of Canada and the Federal Reserve. Now, the issue is that the Bank of Canada is in a very tough spot when we have an environment where economic growth and interest rate expectations are diverging between Canada and the US. Now, the reason why the BOC still expects rate cuts is because it still has a very dovish outlook. The Bank of Canada expects inflation in Canada to fall to 2.5% in the second half of this year. And it also revised its inflation forecast lower for 2024 from 2.8% to 2.6%. So the Bank of Canada expects inflation to decline more than it previously did in Canada. So why is that? So first, it's seeing lower goods inflation, and that's primarily being driven by a decline in food prices. So that's expected to continue. So lower goods inflation driven by lower food prices. The Bank of Canada is also seeing lower inflation for services. That's being driven by a weaker labor market. We recently saw the unemployment rate in Canada pick up. It's also partially been driven by price competition and price cuts by telecom companies. So, for example, Rogers, Bell, Telus have been lowering prices on cell phone plans. That's leading to lower services inflation, and that's helping CPI. But the Bank of Canada expects that to moderate going forward. So the risk to the Bank of Canada's outlook is really tied to two components. One, energy prices, and two, the Canadian dollar. So when the Bank of Canada sets its policy rate, it doesn't forecast the price of oil, and it doesn't forecast the Canadian dollar. So it's moved the assumption for the price of oil up to $85 a barrel based on the recent increase in energy prices. So that's already baked in, but it doesn't make a call on the future price of energy or the future change in the Canadian dollar. The issue here is that we are seeing energy prices pick up. There's also geopolitical risk that could lead to oil prices moving well above $85 a barrel. If that happens, that's going to flow through to CPI because energy is a big part of CPI, gasoline, as well as the flow-through impact for every other goods or service, because energy is a component, input cost to almost everything we use or buy. So that could be another or factor that moves inflation higher through the rest of 2024. The other issue is that if rates are expected to remain higher or move higher in the US, but decline in Canada, that results in a weaker Canadian dollar. And you've already seen that over the last 2 days. The Canadian dollar was about 74 cents relative to the US dollar at the start of this week. It's now already declined to 73 cents. And that's the market reflecting that the currency depreciates when interest rates diverge between two economies. And the challenge for Canada is that we do not produce most of what we consume locally or domestically. So, for example, for food, about 70% of our food is imported. So if we have a weaker Canadian dollar, that could reverse the decline in food prices or lower food inflation we've seen over the last few months and year to date. So we could end up in a scenario where the economy is weakening. That's continuing to lower services inflation, but that decline in services inflation is more than offset by an increase in goods inflation due to higher energy costs and due to a lower Canadian dollar. And if inflation remains elevated, that could push out rate cuts further for the Bank of Canada as well. So the Bank of Canada is in a tough spot. I think the Tiff Macklem wants to lower the policy rate. I think he made it clear that he is open to cutting the policy rate in June. The problem is that the market anticipates a lower policy rate and the Canadian dollar sells off. That could work against the Bank of Canada because it results in higher goods inflation, which would mean that the Bank of Canada either has to cut less than it would like to cut or may not be able to cut rates as soon as it would like to cut rates. Another issue is that shelter costs are also a component of CPI, mortgage interest costs and rent. And that is ironically driven by higher rates. So that is one component of inflation where if rates remain elevated, it's going to put upward pressure on CPI. So putting all of this together, I think the recent developments this week has led the market to start moving away from that no landing, which is the best case scenario, and starting to think about either a hard or harder landing due to interest rates and elevated interest rates resulting in a recession down the line, or maybe even a stagflationary scenario where we have a recession environment or weaker growth, but inflation does not move down. There are also implications for risk assets, but I'll just pause there if there's any questions about that first part and the outlook on interest rates.
I'm okay, actually. I'm taking notes and I'll ask my questions in the end, but let me ask if anyone in the audience has a question for Nigel. But thank you, Nigel. Thank you for setting that context on how the various components play with each other and how they might play out and influence the decision. And so I don't know if anybody has questions. I guess not. You can keep going.
Okay, so great. So that's the background of the potential scenarios that could play out, as well as what could drive inflation and policy rates. Now, if we bring that to the impact on financial markets, either equities and my specific sector, banking, and the real estate market, there are multiple read-throughs here. So the first read-through is for banks. And when I look at my sector, you look at banks over the last few months, really since October, bank stocks have rallied substantially since bottoming in October of last year. And that rally was driven by an expectation for rate cuts. At the start of this year, or heading into 2024, the market was pricing 7 rate cuts in 2024. That's reversed entirely now for the most part, and we're now to less than 3 rate cuts in 2024. And what's happened is that the market is now starting to contemplate that rates will go down, but later than anticipated. And that's an issue specifically for banks, because the outlook for banks is very dependent on the outlook for credit risk and credit losses, or provisions for credit losses. And provisions for credit losses are driven by interest rates and the impact on interest rates on servicing debt, as well as the impact on collateral values. So banks previously or recently stated that they expect credit losses to peak sooner rather than later. And that's based on, or was based on, an expectation that we would start to see rate cuts in June. And the reason they expected that is when you have rate cuts, that benefits collateral value. So for example, if you think of commercial real estate, if rates are declining, then banks can assume that lower rates will lower the burden of servicing debt for individuals that have commercial mortgages. It also improves the valuation of commercial real estate assets, because the cap rate, which is how these properties are valued, will also decline when the risk-free rate is declining. So valuations move higher and the stress on servicing debt moves lower. That reduces the credit loss provisions that the banks would expect to take, or the losses that the banks would expect to experience. So that's on the commercial side. On the consumer side, it's very straightforward. It has to do with the amount of disposable income that households need to put towards principal and interest payments. This is referred to as the household debt service ratio, or DSR. And the issue is that that DSR metric, heading into 2024, is already at previous cycle highs. So during the financial crisis, the debt service ratio peaked at 15% in 2007. Heading into the pandemic, it also peaked at 15%. And it's sitting at 15% heading into 2024. Now, if interest rates remain elevated, that household DSR will continue to move higher. And a higher DSR has been a reliable leading indicator of an increase in credit losses. In past credit cycles, when the DSR peaks, credit losses typically peak within 2 years. So we're not yet at the peak DSR for households because interest rates are still elevated. If we get interest rate cuts in the second half of this year, we can assume the DSR will peak sometime this year, and it'll peak at a new record high above 15%. So that puts the peak in credit losses probably sometime in 2025, maybe 2026. Now, without getting too in the weeds, there is a new accounting standard for banks where they can recognize credit losses on loans that are still performing. So in other words, today, banks don't have to wait for a borrower to default in order to recognize credit losses. So that's going to pull forward some of the credit losses. So we think it's very likely that credit losses will peak earlier than it has in the past. So we think 2025 will be the peak in credit losses. Now, another issue is that the transmission mechanism for debt service payments has changed for households. During the financial crisis, what drove the increase in debt servicing costs was non-mortgage debt. So think of credit cards, auto loans, revolving lines of credit, like unsecured lines of credit. That's what drove the increase in borrowing costs or debt servicing costs. And when interest rates were cut, you saw a pretty significant and rapid decrease in debt servicing costs driven by non-mortgage debt. The difference today is that after the pandemic, individuals paid down, or during the pandemic, households paid down non-mortgage debt, credit cards, revolving lines of credit, with the excess savings and stimulus and deferral programs that were rolled out. And that was replaced by households taking on mortgage debt. So we've had a significant shift in the composition of household debt away from non-mortgage credit towards mortgage credit. And that changes the way debt servicing costs or the interest rates are passed through the household, because it takes longer for mortgages to renew and for monthly mortgage payments to increase, because those are typically 5-year terms, whereas non-mortgage credit is typically floating rate debt that will immediately have a higher interest rate and higher debt payments, or it's a shorter term debt where it'll reset more quickly. So because we have a different transmission mechanism, it's taking longer for debt servicing costs to go up, but they're going to continue to go up. And the bulk of residential mortgages for banks renew in 2025. That's why it's a significant risk for the banking sector if interest rates are still elevated heading into 2025, because not only do you have more mortgages renewing in 2025, a lot of the mortgages that are renewing include mortgages that were taken out in 2020 when rates were very low, sub 2% for variable mortgage rates. So not only do you have more mortgages renewing, but the payment shock would be higher for the mortgages that are set to renew next year. Another implication is that when rates are cut eventually, the transmission mechanism will take time, because it's going to take long for those residential mortgages to also renew at lower rates. So not only are we going to have a new debt servicing ratio record high sometime this year, but when we finally do get rate cuts, it's going to take longer for those rate cuts, the benefits of the rate cuts, to flow through as lower mortgage payments for households. Another issue is that we have an inverted yield curve. So an inverted yield curve means that the short end of the yield curve, which is 3 months, 1 year, up to 5 year, is higher, the rates are higher than the long end of the yield curve, right? So for example, 10-year, 20, 30-year yields. So when you have an inverted yield curve, it results in variable rate mortgages having higher interest rates than fixed rate mortgages. And if we get rate cuts, there will be a benefit to variable rate mortgages, because the prime rate will go down and the variable rate is linked to the prime rate. So the variable rate will decline when the Bank of Canada cuts interest rates. But the 5-year yield, because it's already lower than the Bank of Canada policy rate, the 5-year yield in Canada is 3.7. The policy rate is 5.5. It may not decline at all, and it likely won't decline, because in a normal environment, you need to have a positive sloping yield curve where longer term yields are higher than short term yields. So what that means is, in reality, when rates are cut by the Bank of Canada, it won't provide any benefit to fixed rate mortgage holders, because the fixed rate will probably still remain around 5%. What it will do is it will narrow the spread between the variable rate, which is closer to 7%, and the fixed rate, which is closer to 5%. So when we get rate cuts, we're probably just going to have a variable and fixed rate that's similar at around 5%, rather than having a benefit. In order to have a benefit, you would need rates to decline significantly and get back to 2% or lower, which is what we saw before well, not only during the pandemic, but also before the pandemic, we had a 2% policy rate. So we need to get back that pre-pandemic policy rate of 2%. The challenge is that it's very difficult to get back to that 2% policy rate without having a recession, because you need substantially weaker economic growth for the Bank of Canada to justify a rapid decline and a significant decline in policy rates. So what I mean by that is if the Bank of Canada cuts policy rates by 100 basis points or 1%, we're still at a very elevated level of a 4% policy rate. Heading into the pandemic, we were less than 2%. So that's not enough to provide a relief for households. You need that policy rate to get to below 3%. And the only way the Bank of Canada can get there before 2025 is for a recession to reduce inflation significantly because of higher unemployment. So this is a very challenging landscape for banks. And then you have other implications where if the credit environment is deteriorating and banks are taking more credit losses, there's also going to be less willingness for banks to lend. So there will be less bank credit extended to the economy, and less availability of bank credit would also be a headwind for economic growth. So that's the banking sector. There's, of course, implications for the real estate market as well. So the real estate market, we really focus on the resale market. And we focus on what drives resale prices, and it's typically marginal demand and marginal supply. So marginal demand we measure as the amount of units sold within 30 days. And marginal supply we measure as the amount of inventory in the resale market, which can be referred to using the active listing metrics, right? So the amount of properties that are actively listed. So the ratio of those two, active inventory over sales, gives you months of inventory. And there is a strong relation between MOI, or months of inventory, and real estate prices. When MOI is going up, that means there's excess supply. And you see in the following 6 months, prices decline, and vice versa. When MOI is going down, there's less excess supply and there's more excess demand, and prices go up in the subsequent 6 months. So what's happened since October of last year is we've seen an increase in months of inventory. So months of inventory hit a recent low in October, and it's reversed. And it's reversed based entirely on interest rate expectations. So in October, we had central banks come out with dovish commentary and signal that they're going to pause rate hikes and start looking towards rate cuts. The markets, as well as individuals, took that commentary and looked ahead to rate cuts in 2024. And based on that, you had demand come back in the real estate market with buyers that are looking to front run those rate cuts and get ahead of any expected price increases. And on the flip side, you had sellers that are now going to hold off on listing their property because they want a higher price after rates decline, or if they are under financial stress, they can hold down a little bit longer for rates to decline and then maybe refinance or find a way to get a lower interest rate. So when you have that dynamic of supply being constrained because individuals are waiting for rate cuts, and then demand being amplified because individuals are front-running rate cuts, you get excess demand relative to supply. And that resulted in months of inventory moving up substantially from the recent low in October. And it's supported real estate prices over the last few months and year to date. We haven't really seen any real estate price declines despite a high level of interest rates. The challenge now is that this week we're starting to see a shift in consensus expectations for interest rates. Heading into this week, there was an expectation that rates would start declining in June. Now, at least for the US, there's clearly a shift away from that. And now the consensus is moving towards rates starting to decline in September and maybe even December, because the Federal Reserve does not want to cut rates right ahead of an election, because it doesn't want to seem or have the appearance that it is interfering with the political outcome of an election cycle. So even if the Federal Reserve wants to cut rates in September, it might push that to December after the election in order to look or maintain its political independence. So now we could get the first rate cut in December for the Federal Reserve in the US. And although the BOC still indicates a willingness and a preference to cut rates in June or July, the market is starting to understand that it may not be able to, because if the US dollar is going up due to interest rates staying higher, and if US bond yields are going up, then bond yields in Canada have to go up, and the Canadian dollar will decline, which means that the Bank of Canada likely can't cut interest rates because it will have to revise its inflation outlook. And although it doesn't forecast the Canadian dollar, if the Canadian dollar is at 72 cents or 70 cents instead of 74 cents, Bank of Canada will have no choice but to increase its forecast for inflation because you're going to have higher goods inflation. The only way that could be offset is if the economy is weakening significantly, so that services inflation comes down, but that also is a negative because you have higher unemployment, and higher unemployment is bad for the economy. It's also bad for banks because it will result in more credit losses for consumer loans. And then banks will lend less, which will lead to lower economic growth. So we're in a very challenging spot in Canada where we either have to have really weak economic growth or we have to have higher interest rates for longer. And neither one is a good outcome for risk assets. But in my view, if you ask me, well, what's the best possible outcome? We tell our clients that a hard landing or recession is a good outcome. Yes, it's negative in the short term, but if we have a recession, let's say we have it sooner rather than later by June, that gives the Bank of Canada the ammunition it needs to start cutting rates. And while in the near term it's negative because you have higher unemployment and a weaker economy, which also hurts businesses, if we get rate cuts that are justified because lower economic growth also leads to lower inflation, so the Bank of Canada can cut rates without being concerned that inflation is going to remain high or move higher, then we have an environment where heading into 2025, we have a lower interest rate, and that takes a lot of risk off the table and will also be more supportive of real estate markets. So although it seems counterintuitive, the best case scenario is actually a recession. A worst case scenario is the economy keeps muddling along and inflation doesn't come down and the Federal Reserve can't cut interest rates and we head into 2025 and the policy rate is still around or above 4.5%. That's going to be an issue because the amount of mortgages that are renewing next year and the payment increase that's going to occur next year, that is going to lead to, I think, more credit risk for the banking sector as well as more risk for the real estate market because you're going to have more individuals that are going to face financial distress and perhaps be or become forced sellers, and that's going to lead to more inventory. In the short term, it's all about sentiment and interest rate expectations. So there might be a slight weakening of the outlook of interest rate cuts, but not significantly just yet, at least not in Canada. But if there is a shift where the consensus outlook for the average Canadian is from rate cuts in June to rate cuts in September, then you could see more people capitulate, throw in the towel, list their property for sale. That could result in more inventory. And then on the flip side, you would have less individuals trying to front run rate cuts because rate cuts are now being pushed out or they're less certain to happen. And then we get the reverse of what we've seen from October to April, where you have more listings hit the market, but less demand. That will push months of inventory higher, and that would be negative for real estate prices. We're still significantly below past cycle peaks in months of inventory, so we're not at levels that are close to previous peaks. We're kind of at the average historical level or mid-cycle level. But if we do get that dynamic where listings move up and sales remain suppressed and MOI starts to move to the previous peak, that would be negative for real estate and we'd have an outlook and update for our clients. So that's the balance of risks that we see right now. It's really tied to not just inflation, but how that impacts the outlook for interest rates and sentiment over the near term.
When you talk about, thank you so much. I was like, I hope I captured everything. I hope it's getting recorded for me to review it again. But that was very, very well explained. Thank you so much. This is profound. I don't know when I have felt so I was like receiving so much knowledge and wisdom in like 15 minutes, and than ever before. Um, in terms of real estate, there are lots of scenarios that can play out. But if you were planning for the next year or two, from what I am gathering from, or my net takeaway is that um, there's no time soon that the interest rate will be low enough that prices will go crazy. That isn't a potential scenario in 24 or 25. It's either going to get higher, which means it's difficult life for everybody, and therefore you can't see that valuation move up. Or it is not that bad, a little less bad, and yet it is not crazy. It won't go down to like an all-time low level where people are simply getting cheap free money to buy, spend on whatever they would want. In that context, you talked about resale. Do you think that new construction or construction starts could have the same level of thinking? So imagine the constructions that are starting in 24 or started last year, or like they were just in zoning, like construction that's going to hit the market in say about 4 years from now. Where do you think, or since I'm talking about people on the platform, how do you think potential investors should try to evaluate? 24 seems to be pretty much not a fun year. Maybe it's not that bad, maybe it's a little bit bad, but it's not fun as far as an easier life, which is a combination of wage growth, not crazy inflation, not crazy costs of mortgage, all of those things put together as a household. You're surviving. But if you're thinking about you did have some spare cash and you should be constantly investing and not waiting for the best days in the world, would you think, how do you think should people evaluate new construction, which comes to market 4 years from now?
Sure. So when it comes to investing, just as a blanket statement, obviously I recommend referring yourself to a financial advisor or a financial planner or whatever investment professional that can give you advice on your personal situation. But as a broader statement about the real estate market, what I can say is what we're really talking about is the commercial real estate space and the impact on both office and multifamily commercial real estate. And it's important to make that distinction. That's where we're seeing the stress right now. You're referring to multifamily or construction, but and development, real estate development. But both sides are important because bank credit is right now being pressured by office properties. And the structure of debt is different for office properties than it is for construction and development companies, right? And the difference is that an office property operator or owner will typically have a commercial mortgage that could be 5 to 7 years or shorter. And that's typically a fixed rate loan, and they'll renew at a high interest rate given where rates are today. That is a different dynamic than what happens in the construction development space. In the construction development space, it's typically a floating rate loan, not a fixed rate loan. So we've seen developers and construction companies in the real estate space in Canada have to absorb higher debt servicing costs because they typically borrow on a floating rate basis. And they're also being pressured by weaker pre-sale activity and lower completion rates because individuals that did purchase a condo or pre-construction property years ago now are having difficulty qualifying when they have to close on that property because interest rates are higher and they can't pass the stress test, or the appraisal value of that property is less than the contractual purchase price that they agreed to when they bought that pre-construction. So you're seeing individuals walk away from deposits and not close because in many cases, particularly in the condo market, you have the purchase price above the current resale or market price. Now, while developers ultimately have the legal right to pursue that buyer and recoup any potential loss. In the short term, it causes liquidity issues because those developers were expecting those properties to close, and they were expecting to have an inflow of cash from that they could use to manage liquidity and the balance sheet. And now that that has been under pressure, you are seeing more developers fail. There have been developers both in Toronto and Vancouver that have declared creditor protection because of lower completion, higher debt servicing costs. And on top of that, you also have wage inflation for people that work in the construction industry, and you also have higher commodity costs or input costs for building materials. So everything is going against real estate developers and construction companies. And the other issue is that in order to get new supply, developers need financing. In order to get financing, you need to pre-sell a certain number of units in your development. But because of negative or weaker sentiment and more difficulty qualifying, pre-sale activity in demand is also lower than it typically is. So it's also more difficult for developers to find projects that make economic sense because you have weaker demand and you have higher debt costs. So ironically, the elevated interest rate environment is reducing supply of new construction units or completions or new project developments because of higher debt servicing costs and weaker pre-sale demand. So it's working against housing affordability. So that's the irony of the way we've set up our real estate industry. Now the government is trying to get around that and we try to support supply by having insurance on commercial loans to the real estate and development sector. So you can see a lot of policy decisions to provide funding on an insured basis, which lowers the cost of debt and makes it more viable for real estate developers to build out these projects. But that is not in of itself enough to meet the structural undersupply of Canada's real estate market. So we're not going to get there through higher supply in terms of more affordable housing. You also have policies that increase demand, either through programs like the First Home Savers Account or through the recent announcement of extending the amortization length of insured mortgages. All that increases demand. So you have policies that on the government side, yes, they incentivize supply, but they also incentivize demand. So it kind of cancels out. And then you have issues in the developer space and the construction space from having debt that is mainly linked to floating rates rather than fixed rates. And then you have a broader issue with commercial office, lower vacancy rates, and those commercial mortgages also renewing. So all of that makes it very difficult to fund new development because banks are going to probably be more selective in extending credit to the commercial real estate sector. So it's a tough environment. It's also very difficult to make a recommendation on the best strategy here, because if you do purchase a pre-sale or pre-construction unit, you might not close for another 3, 5, 7 years. So if you could tell me what the interest rate level is in 3 years, you can tell me what the economic environment is in 3 years, what government policy is in 3 years or 5 years or 7 years. Okay, then you could maybe, make a decision, but no one knows. So it's very difficult to say. What we can say though is that there is stress and pressures building that's creating challenges for the residential multifamily market.
Thank you. Yeah, I feel like when you're doing pre-construction condos or anything that's 3 to 5 years out, you're pretty much kicking the can down the road and hoping that as long as the fundamental dynamics of supply and demand remain, assuming other factors are not all bad at the same time. Like, it's not like you had a pandemic followed by a recession and followed by a whole bunch of other issues. If it isn't that culmination of a whole bunch of negative macroeconomic headwinds, hopefully the demand supply factor would turn out to be okay. That's kind of the assumption when people do long-term investments like that.
Yeah, and I would also recommend you have to differentiate between long-term or secular trends and short-term or cyclical trends, right? So long-term trends are, or long-term fundamentals are constructive for Canadian real estate because we have a significant structural undersupply of housing units. We have high levels of immigration. And we also have a favorable political environment. Also, our climate is more insulated from the risk of climate change. So there's a lot of long-term trends that benefit real estate, but in the short term, in the next 2 to 3 years, all that will really matter is sentiment on real estate by individuals in Canada and the outlook for interest rates. And I say the outlook for interest rates and not the level of interest rates, because when you look at what's happened over the last few years, since interest rates started moving up in 2022, we did not see a significant price correction in real estate. We did see, of course, some softness and a decline in real estate prices from the peak in early 2022, but we didn't see a real material significant decline in real estate prices. And that was driven, in our view, almost entirely by interest rate expectations. Throughout 2022, there was an expectation that the policy rate would not be raised above 2%. And then when it was raised about 2%, there was an expectation that the Bank of Canada would cut policy rates fairly quickly and fairly significantly. That has kept a lot of individuals on the sidelines and not resulted in a lot of forced selling. So you haven't had that excess supply that you need in order to result in lower prices. And on the sentiment side, Canadians are still on the whole very bullish on real estate and still have a very positive outlook for real estate. So unless something breaks the sentiment for real estate, and for that to happen, you probably need moderate to severe recession. You need equity markets to be in a bear market and declining. You would need the outlook for interest rates to still be negative. So you would need all those variables to come together to break sentiment, because without breaking sentiment, you won't have forced selling or panic selling. And without forced selling or panic selling, you cannot get a significant decline in the real estate market through a substantial increase in inventory. So where we sit today, there's still positive sentiment and there's still expectations for rate cuts. So anyone that is a forced seller will probably still hold. So I don't think there is going to be any panic selling or forced selling over the near term. But if rates remain elevated and we don't get rate cuts, or rate cuts continue to keep getting pushed further and further out, it increases the risk that you have more individuals list their market for sale and that inventory starts to pick up. And when I say risk, I mean risk specifically to real estate prices. The banks as a whole are more or less protected because, number one, they have about 30% of their mortgages are insured. And the mortgages that are not insured, they have a loan to value that's typically around 50 to 55%. So that means on average, you need prices to go down by at least 40 to 50% before a bank would take a loss on an uninsured mortgage. So it's very unlikely they're going to take losses. And on the flip side, prices are still well above pre-pandemic levels. So there's any individual, for whatever reason, they are under financial stress and they need to sell the property, they can because they have positive equity. So it's when you think about risk in real estate, you have to think about vintages of mortgages. So it's only the vintage, and by vintage I mean in a given year, what mortgages are renewing, right? So in 2025, the vintage will be the 2020 vintage that is up for renewal. So the reason why that's important is because you have to think about whether or not those mortgage holders are going to have positive equity or negative equity, right? So prices are still above 2020 levels. So the equity is still positive. And if you have positive equity in your house, you're not going to default on your mortgage because it's much better to sell your property and move or downsize or rent, whatever you have to do, than it is to declare bankruptcy and take that hit on your credit score for the next, at minimum, 7 years. So individuals will rather sell the property than default. It's not until you get to maybe 25, 26 and you have a scenario where prices go down to 2020 levels, that we can even begin talking about losses for the banking sector. So it's not losses for the banking sector that's the risk, it's price declines in general because of more forced sellers that might weaken sentiment for real estate. And of course, in Canada, a lot of our economy is related or tied to real estate. And also individuals own real estate. So if real estate prices are going down, they'll feel poorer or the economy will weaken. And that's going to lower spending, and it's also going to increase unemployment, and it's going to further amplify any price decline. So it's a very we're kind of in a very interesting spot at the moment, and it's very difficult to say how this will turn out because a lot of it will depend on what people expect and think, and that could change week by week. If we had this conversation last week, it would be a completely different discussion than having it this week.
Yes, I mean, while we were setting up the webinar and talking about it, I was pretty much there was a very high probability that this would be like this is the first cut, or we actually have a date for a cut. Was the expectation going in? But I think, yeah, this it was not a total surprise, I would say, given how things were trending, and especially with the US data. But yeah, I think it was still, there was hope that it may not be the current situation as we are in. We talked about real estate and long term and short term. And if I have to do one nugget of takeaway and tell me if I am misinterpreting this, yes, there are lots of variables and lots of components, but if you think in terms of long term fundamentals for real estate in Canada, they are still strong and they're not changing overnight. The lot, however, the actual outcome 10 years from now might depend on what the sentiments are at a given point in time. And then the second component, which you talked about, and which sometimes we are very careful about, is will the developers stick around and be able to exist for the next 10 years? I think that's the only big risk I see is like, hey, if there's a developer who probably has the wherewithal just because of their backing, their network, their pile of cash they are sitting on, whatever it is, that they will be able to sustain higher interest rates, higher cost of wage workers on their team, and a higher commodities prices, then it should be okay, because on the other side, the long-term fundamentals will hopefully kick in at that time. We don't know, but if you're only projecting long-term fundamentals, we'll still be okay.
Yeah, I mean, there's a couple of things to unpack there. I think the first part is on developers. You can't lump them all in the same bucket because there are different tiers of developers, and the tier one developers are still doing fine in terms of their balance sheet and liquidity risk. There's no concern about those developers facing any issues. It's really the lower tier developers, the smaller developers, the less experienced developers that maybe don't have very good balance sheet or liquidity management or risk management that may be facing in bankruptcy or some sort of credit issues. So the type of developer matters and the quality of developer matters a lot. And the second point about long-term versus short-term, yes, it's true. Long-term is still fundamentally positive, and there are a lot of trends to support the long-term appreciation of real estate prices. But you have to think about what that experience is like in the short term, and how could that actually play out. So if you go back to the early 1990s, when we last had a substantial real estate price correction in Canada that was localized in major markets like Vancouver and Toronto, if you purchased in 1990, it would take about 8 to 10 years for the prices to return to that 1990 peak. Now, of course, if you bought in 1990 and held to today, you've still done exceptionally well. But if you were an individual that bought in 1990 versus 1992, that would make a significant difference in your experience of holding that asset, and also your expected returns for that asset. The price that you buy an asset at is also very important. And it's true for real estate or stocks. The more favorable the valuation, the higher the likelihood you're going to have a high or positive or strong rate of return. And the more expensive the valuation, the lower the likelihood. So it's not necessarily that you still will not make money over the long term. You could still, if you buy real estate in any market that has long-term positive trends, you could still end up doing really well over a 20, 30-year period. But the short term, quote unquote, like the 1990s, could be 10 years before you see the price return to the previous peak. In that example, I'm not predicting that. I'm not saying that's going to happen, but I'm just saying you can't ignore cyclical factors because that in certain scenarios could end up meaningfully impacting the rate of return that you might even see over the next decade, depending on the purchase price or your cost basis for that asset.
That's fair. Yeah, I mean, that was a very, very delightful conversation, Nigel. I think thank you so much for educating definitely me. And I'm not sure if audience has questions or they are still wrapping their head around all of the variables that you spoke about and their interplay. And I think while making investment decisions, it's very mindful to be aware of all of the various factors and their interplay. And it's just not just interest rate, but what happens if US doesn't and Canada does, and then what happens, and then now how the impact on the currency, and therefore the impact on imported goods, and therefore back on inflation happens. It's like saying, okay, you want Bank of Canada to cut? Yeah, there you go. But then what happens? The currency declines, and then all the imported goods become expensive, which means inflation is back up, which means Bank of Canada can no more cut. And so it's just acknowledging, while we all know in our silos that those exist, how the world is interdependent. There are some local and regional and industry level factors, but there are overall factors, and the fact that you keep reiterating is the sentiment piece, which is it's not just the interest rate, but what we people think or expect the interest rates to be has a huge it's almost an emotional play, I would say, not always a rational play, but it's a huge emotional, almost behavior economics component of it, which is saying rational economists wouldn't make this decision, but humans will make a different decision, even if they know everything the same. We at Buy Properly try and do our bit. We're not financial advisors, tax advisors, investment advisors. So starting with my disclaimer on all of those, I think our fundamental assumption is that in this whole interplay of things, all we are doing is make things a little bit better with tech to say, hey, can I reduce the cost of the overall investment process? And maybe we save a couple of percentage points here and there for everybody by using tech. Maybe we give them more content like we did today, and give them more tools where they can run calculators and scenarios and equip them well to make good decisions. But also just make things better. Like you talked about the developers who may not be able to raise money or raise credit from traditional channels just because they're so stressed out. They're not bad developers. They're not fraudsters. They're not trying to fly by night. It's just life is tough right now for them. And so if we could connect them to other people who are looking to invest, hopefully some of them who genuinely just want to go build and sometimes aren't as clued into the finances or the tech may fare better. And I think that's sort of our play and little contribution to this space of investing in real estate and development, and that's why that was one of the reasons why we wanted to expand beyond just real estate into private credit and other asset classes, which customers can see is say, hey, if we are using tech, if we have made things efficient, let's extend it to more and more of the investment space so that we can make things a little bit better by reducing cost of doing business using tech. But we don't tom ourselves on saying we use AI all the time, but there's a whole bunch of tech we use in the background, which keeps overall costs of doing the same things lower at a scale which we do. We are out of time, so I think this was almost eye-opening for me. I feel very, very educated and informed. I have taken some notes. I hope the viewers did too. Thank you so much, Nigel, for joining us today. And we can't wait to hear from you again and hear your perspective next time, maybe July. We hopefully Bank of Canada does something we are excited about. But thank you so much for joining us.
Thanks for having me on. Appreciate it.
And thank you everybody who joined us for the session. There will be a recording available if you wanted to go into each of these later on. Just a reminder, as Nigel did, full disclaimer and disclosure, this is not financial advice, tax advice, financial planning, or even our hunt on what the market will do. This is us discussing what are the various scenarios we feel may pan out, and hopefully you will make decisions based on some of this information, but choose what's done best for you and consult your advisors for any decisions. Thank you.
Thank
Thanks,
you.
everyone.